Want to get a piece of the action of nearly $10 trillion? Looking for a market-beating yield backed by double-digit dividend growth? Like the idea of investing in a world-class business while it's on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a massive asset manager. The asset management business model is gold. You get direct exposure to global capital markets, money. And asset managers collect fees to manage assets within the global capital markets, money on top of money. And the fee base is compounding money. That's why this business continues to ratchet its revenue, profit, and dividend higher and higher. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of BlackRock Inc., which appear to be trading at a significant discount today. BlackRock Inc., stock ticker BLK, is a multinational investment management corporation. Founded in 1988, BlackRock is now a $100 billion by market cap investment management monster that employs more than 19,000 people. With approximately $9.1 trillion in assets under management, BlackRock is the largest asset manager in the world. Equity products account for 52% of the company's long-term assets under management, fixed income products 29%, multi-asset class products 8%, and alternative investment products 3%. Cash management accounted for the remaining 8%. The asset management business model is extraordinary. Put simply, BlackRock charges fees to manage global assets. Simple enough. But this simplicity doesn't detract from how effective the business model is at making money. The effectiveness is a result of the fee base exponentially increasing. See, BlackRock has massive exposure to global equities. The swelling of the world's population and collective economic output helps to fuel compounding growth across the spectrum of global businesses. What that means is BlackRock's fee base is compounding over time. On top of that, BlackRock's huge scale supercharges the process, putting distance between them and the competition. BlackRock is in a rising tide, global capital markets, that's lifting all boats, participants in said capital markets. However, since BlackRock is the largest boat in that rising tide, the company stands to disproportionately gain from all of this. BlackRock's unrivaled ability to benefit from scaled compounding sets the company up to continue growing its revenue, profit, and dividend for many years into the future. Indeed, BlackRock has increased its dividend for 14 consecutive years. The 10-year dividend growth rate is 12.5%. And up until recently, due to extreme market volatility, consistent double-digit dividend growth has been a hallmark. Pairing that kind of dividend growth with the stock's market-beating 3% yield is a compelling combination. By the way, this yield is 50 basis points higher than its own 5-year average. The 62% payout ratio is healthy, but this is kind of a trough ratio, and I believe it'll become healthier as markets and results recover. I like dividend growth stocks in what I refer to as the sweet spot, a yield of between 2.5% and 3.5% paired with high single-digit or higher dividend growth. The yield is dead center, and the dividend growth rate is quite a bit higher than I'd usually look for. extra sweet dividend metrics here. Looking at business growth, BlackRock enlarged its revenue from $10.2 billion in fiscal year 2013 to $17.9 billion in fiscal year 2022. That's a compound annual growth rate of 6.5%. Very solid top-line growth. I tend to look for a mid-single-digit top-line growth rate from a large, mature business such as this. BlackRock more than delivered. Meanwhile, earnings per share grew from $16.87 to $33.97 over this 10-year period, which is a compound annual growth rate of 8.1%. The top line looks very good. The bottom line looks even better. Share buybacks help to drive much of the excess bottom line growth. For perspective on that, the outstanding share count has been reduced by approximately 13% over the last decade. Notably, the growth of the dividend has outpaced earnings per share growth, but that's largely due to how shaky the last 12 to 24 months have been. Many prior 10-year periods show a 10% plus EPS compound annual growth rate, which I believe BlackRock is good for over the long run. Looking forward, CFRA is forecasting a 13% compound annual growth rate for BlackRock's earnings per share over the next 3 years. Well, how about that? We're clearly on the same page here. Recent turbulence is hiding just how powerful BlackRock's platform really is. To that point, CFRA states, and I quote, "A decline in asset values is masking relatively decent long-term asset inflow trends like the $393 billion recorded in 2022, equal to 4% organic AUM growth," unquote. I'd argue the inflow trends reveal two important points. First, we can see that BlackRock is capable of pulling in capital during rough periods for markets, which bodes extremely well for better times ahead. Second, in an industry where many major firms are plagued by outflows, BlackRock's diversified mix, particularly around passive offerings, is proving its worth at bucking the trend and rising above the competition. CFRA notes, again, and I quote, "BlackRock generates above peer organic AUM growth, reflecting BlackRock's best-in-class product mix, technology platforms, and capabilities," unquote. In my opinion, it's the passive offerings that really set BlackRock apart. Unlike many of its peers, BlackRock is actually mostly a passive investment firm. BlackRock owns iShares, the largest provider of exchange-traded funds, or ETFs, in the world. Passive strategies account for roughly 2/3 of BlackRock's AUM. This differentiation is crucial as capital has been flowing into passive investments for years, much to the chagrin of asset managers that focus on active strategies. CFRA's projection for EPS growth over the next few years would set up BlackRock for similar dividend growth, although the elevated payout ratio will also have to come down a bit. Thus, balancing things out, assuming CFRA isn't totally wrong, I'd expect BlackRock to deliver at least high single-digit dividend growth over the next few years or so. And I think that's a pretty good expectation for the long run, too. Bolting that kind of dividend growth on top of the 3% starting yield is a pretty nice way to build serious wealth and passive income over time. When we go over to the balance sheet, BlackRock has a fantastic financial position. The long-term debt-to-equity ratio is 0.3, while the interest coverage ratio is nearly 30. Profitability is extremely robust. Over the last 5 years, the firm has average annual net margin of 31.2% and annual return on equity of 14.8%. It's clear to me that this is a best-in-class business with high returns on capital and a stellar balance sheet. And with massive scale, a sticky asset base, a diversified product mix, and global brand recognition, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The very business model introduces exposure to global capital markets and the associated volatility. BlackRock has exposure to economic cycles, and a recession would likely reduce asset valuations along with AUM, fees, and profits. The shift from active to passive strategies moves capital away from certain higher fee products, but BlackRock's leadership in ETFs mitigates this risk. The law of large numbers is a key risk, and BlackRock's huge AUM base makes it challenging to grow at a high rate in percentage terms. BlackRock is a global entity with geopolitical risks. I see most of these risks as being pretty standard for a very large asset manager, but BlackRock is anything but standard. And with the stock down more than 30% from its all-time high, the valuation is now anything but standard. The stock is trading hands for a PE ratio of 20.3. That's roughly in line with its own 5-year average. However, most other multiples are more favorable. Take the cash flow multiple, for instance. At 20.2, it's well off of its own 5-year average. of 26.8. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate is on the high end for me, but it's not as high as I can go, but I think it's warranted here. It's much lower than the demonstrated dividend growth over the last decade. It's also below the proven EPS growth over the last 10 years. Based on where the near-term earnings per share growth forecast is at, this kind of dividend growth could easily be supported even while the payout ratio simultaneously compresses. I don't see anything unrealistic about this. If anything, it's mildly conservative. The dividend discount model analysis gives me a fair value of $860. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates BLK as a 4-star stock with a fair value estimate of $810. CFRE rates BLK as a 5-star strong buy with a 12-month target price of $805. We have a tight consensus this time around. Averaging the three numbers out gives us a final valuation of $825, which would indicate the stock is possibly 21% undervalued. Here's the bottom line, guys. BlackRock Inc. is a best-in-class business that disproportionately benefits from a rising tide lifting all boats. With a market-beating yield, double-digit dividend growth, a reasonable payout ratio, nearly 15 consecutive years of dividend increases, and the potential that shares are 21% undervalued, long-term dividend growth investors would be wise to take a close look at this name right now. And now for a special news announcement. Accenture PLC, stock ticker ACN, was just awarded a position on the Internal Revenue Service's Systems Modernization Blanket Purchase Agreement, an award which has a ceiling value of $2.6 billion. Accenture just keeps bringing in the contracts and money. We recently highlighted this high-quality compounder, estimating the fair value of the business at just over $310 per share. Don't forget about Accenture. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.